Welcome to RBC's Markets in Motion podcast, recorded November 18th, 2024. I'm Lori Calvasina, head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. 3 big things you need to know. First, over the past week, we've become increasingly convinced a 5 to 10% pullback in the S&P may have already started. Second, post-election company commentary has been heavily weighted to tariffs, a part of the Trump agenda that has concerned many equity investors. Third, other things that jump out from our high-frequency indicators include financial valuations that remain slightly attractive versus the broad market. If you'd like to hear more, here's another 5 minutes. Let's start with takeaway number 1. Over the past week, we've become increasingly convinced that a 5 to 10% pullback in the S&P might have already started. We pointed out last week that valuations on our forward PE models for the S&P 500 and Russell 2000 had some room to run, but not a ton. We also noted that positioning has been looking stretched on the weekly CFTC data for U.S. equity futures, a problem that got worse last week. This all comes after seeing AAII net bulls go up to more than 1 standard deviation above the long-term average several times in early October, a signal of an overbought market that has preceded all of the 5 to 10% drawdowns in the S&P since late 2022. While animal spirits did seem strong a week ago, we noted that given where valuations and positioning were and where sentiment has been recently, the U.S. equity markets seem to have little capacity to absorb bad news, like the dialing down of Fed expectations that's been underway recently. Investors we spoke with late last week also sounded cautious, and our conversations suggest that the move up in the 10-year Treasury yield and the related inflation and deficit concerns is one of the main things spooking them. One thing we've been highlighting on this topic is that the earnings yield gap for the S&P 500 has suddenly turned negative, and late last week stood at minus 0.5%. That's still within a range that's been accompanied by positive returns in the S&P 500 on a 6 and 12-month time frame. But if the 10-year yield moves up another 50 basis points, this model will be back in a range that is usually accompanied by a decline in the S&P on both time frames. The stronger U.S. dollar has also been in focus in our conversations, and here we've been reminding investors that when the U.S. dollar strengthens year over year, the S&P tends to experience downward EPS estimate revisions, driven by the industrial, materials, healthcare, and consumer staples sectors. This is something to keep an eye on as a potential source of disappointment in the next reporting season. For now, we don't think a drawdown in the U.S. equity market would exceed 10%, since declines more than that tend to be associated with growth scares or recessions. GDP forecasts have been firming up for both 2024 and 2025, while U.S. economic surprises have been positive. While all of that could change, for now, it does give us some comfort that any further downside in equities will be limited. Note that a 10% drawdown would also take us down to around 5,400 on the S&P, which is about right where our trailing PE model has told us the S&P 500 deserves to end the year at if consensus forecasts for inflation, the Fed, and 10-year yields end up being correct. Moving on to takeaway number 2. Post-election company commentary has been heavily weighted to tariffs, a part of the Trump agenda that's concerned many equity investors. We relied on transcript analysis heavily in 2017 and 2018 as we navigated several twists and turns in tax reform and the China trade war. And so last week, we read through all of the comments from S&P 1500 companies since Election Day in conference transcripts as well as earnings calls that highlighted their thoughts on what the new administration means for their companies and industries. Many companies referred to the idea that it's still early days in the new administration and too soon to know too much. In terms of specific issues, however, tariffs were most in focus by a mile. Companies emphasized how they managed through the China tariffs and sought to reassure investors by talking about how they've diversified their supply chains. This very much resonates with me. We've seen companies manage through one crisis after another since 2018 very successfully. But 2 things in the commentary from last week did concern me. First, the focus on China. There was very little discussion of what would happen with broad-based tariffs, which is what Trump has been talking about doing in addition to bigger China tariffs this time around. And 2, companies highlighted how they passed on tariffs through pricing in the past, which in my mind gives legitimacy to concerns that inflation risks may be rising again. In terms of the more stock market-friendly parts of Trump's agenda, these did come up, but not to the same extent as tariffs. We found a decent amount of positive commentary on M&A, deregulation, and antitrust, but not much other than expressing general optimism on these matters. Additionally, we found very little commentary on the potential for corporate tax cuts or tax plans in general, another one of the more important stock market-friendly pillars of Trump's campaign platform. Wrapping up very quickly with takeaway number 3, a thought on financials. Financials remains one of the top-performing post-election sectors in both the S&P 500 and the Russell 2000. We're keeping a close eye on the sector, but for the moment we continue to see slightly attractive valuations relative to the broader market indices for the sector within both the S&P 500 and the Russell 2000 for now. That's good news. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.